Okay, when you're buying a property, there are three key metrics you need to know: cap rate, debt service coverage ratio, and cash on cash return. Let me explain all three really quickly. First, cap rate or capitalization rate. Very simple. It means the rate at which you capitalize on the rent. For example, let's say you bought a property for $1 million to make the math easy, and the net operating income is $100,000. You take that net operating income, divide that by the purchase price, and you get 10%. That means you got a 10% return. We call that a 10 cap. You see that number all over the brochures and memorandums. It's basically, if you bought this property with all cash, that's the return you earn on the money. Now, second metric, debt service coverage ratio. Simple idea, but it really matters when you're getting it along. Let's say the same deal, $1 million. Net operating income is still $100,000. But now your annual debt service to the bank is $75,000. That leaves you with $25,000 in net cash flow. To find the ratio, you divide your net operating income by your debt service. So $100,000 divided by $75,000, that gives you 1.33. That number means you're making 1.33 times your debt payment. The higher the number is, the safer the deal looks to the bank. And remember, banks are not in the risk-taking business. They're in the risk management business or risk mitigation business. So when they underwrite your deal, they want to see a strong debt service coverage ratio. The higher the ratio, the safer the loan, and the more bankable the deal becomes. Now, this third metric is the most important metric: cash on cash return. This is the hill I'm willing to die on. Cash on cash return just means what your actual return on the money you put into the deal. It's kind of like a cap rate, but we're looking at how much you invested, not the full purchase price. So again, same example. You buy a property for $1 million. It earns $100,000 a year. You paid all cash. Your cash on cash return is 10%. But what if you borrow 75% from the bank and the seller leaves and the other 25% is financing? Now you bought the building with 100% leverage. You brought $0 to the table. Let's say the building only gives you $15,000 a year in cash flow. That's a little over $1,000 a month. But who cares? Because that $15,000 in income on $0 invested. That's an infinite return on your cash. Anytime you bring in leverage or use other people's money, your cash on cash return goes up. That's why I do the same thing every time. I brought 75% from the bank. Then I sit down with the seller and say, hey, here's how it makes sense for you. Let's talk about you financing the remaining 25%. That way, I get into the deal with none of my own money. And here's the thing, no matter who you are, if you keep using your own money, eventually, one day, you're going to run out. That's why you got to focus on using other people's money to get into good real estate deals. If you want to learn more about commercial property or real estate in general, give a follow, because commercial real estate and buying buildings with no money down is all I talk about. See you in the next video.